This is Professor Hazer again, looking at some real estate here. And this is the third video, which is supports a full valuation and supports the MAC 504 final, and maybe for other courses too. But anyway, so in the last video, we were working on Pfizer. I was working on Pfizer, and we had done the income statement. Okay, and I just want to go over 3 rules just to review. There's 3 ways you can handle items. Number 1 is you can handle items as a percentage of sales. You're going to do this for certain line items which are directly related to the level of sales. Costs are generally administrative expenses are certainly in a maybe a delayed manner. Research and development are that should lead to greater sales, not direct, but there's a relationship there. Amortization of intangibles questionable, but for a drug company, the more patents you have, the more sales you have, so we'll go with that. Okay, restructuring charges, definitely not. A one-time gain, definitely not. So we held those constant. So if there's a relationship between an item, expense, and sales, that you should use the base formula. The base formula results in items which go up as the level of sales go up, as you can see, and the percentages are determined by the percentage that we used in the base year. The base year in this case is 2019. So there's 3 ways. One is you can take them as a percentage of sales, for which you're going to use the base formula done right. And keep in mind, and I can't emphasize how important that formula is, because once you get it right and copy across, then you can copy down, take any line item for which you've used the base formula and come up with that item as a percentage of sales. Copy the base formula down and you'll get it. See what I do for current assets here. Liabilities. Okay, so that's the first thing. If there's something that you don't know, that you're not familiar with, or that's immaterial, both, hold it constant. Just leave it like this. Restructuring charges, it's immaterial, and we don't know what it is, so hold it constant. Just leave it there. In some cases, this is a one-time gain, obviously. You're only going to get rid of the consumer healthcare joint venture once, so those would be 0. It's not a recurring item. Then you've got your taxes here, which is usually as a percent. Also use a base formula for your taxes. And then these items down here, these are zeros because these are discontinued operations. I don't think that Lily's going to have these. So your final income here is income before non-controlling interest. Non-controlling interest, always subtract non-controlling interest. I would keep them constant, and you subtract those. That's the income of companies you own, but that's the income of the portion of shares that you don't own. So if you own 80% of a company, another company, you control it, it's yours, but 20% of the shares are in somebody else's hands. This is the income that belongs to 20%, and it doesn't belong to you, so we sort of subtract that. And you can tell something should be subtracted or not by understanding the statements, both the income statement and the balance sheet you're looking at. Just look at the relationship. You start at 16,302. 29, and it goes down by 29, so obviously you should be subtracting it. Those are the things you have to do to understand. That's why subtotals are so important. They tell the investor, they tell me basically, but that you understand what are individual line items or expenses, revenues, expenses, and assets, liabilities, and what the subtotals are. Subtotals are obviously things you add or things you subtract. Okay, then we're going to come down here, and we don't bother with discontinued operations. I don't think there are any in Lilly. If there are, probably small, hold them constant. Okay, and a lot of this is your judgment. Is something related to sales or not? But it is used as a base formula. If not, either hold it constant or subtotal. Okay, then you've got your weighted average basic shares, and in this case, your income statement shows that your earnings per share went down by a large amount, and that's kind of strange, but that was because they had that one-time gain right there, 0.86. Okay, now we're going to do the balance sheet, and the balance sheet, it's going to be very similar. First of all, we've got to calculate. What I had not done was calculated the percentages for the balance sheet. Okay, and I'm just going to go ahead. All you've got to do, if you've calculated these percentages right, it's kind of like the base formula. If you calculated these percentages right, just go up here, any one of them, because you've frozen the sales number, and then take the percentages all the way down. Get some meaningless percentages because they'll correspond with titles and stuff like that. All right, so I just want to make sure. It looks like they're correct because, notice I say they're correct because we're holding the C14 constant. So if I go down to all these, you'll be holding the C14 constant right there. And that's your sales number up on top. You're just taking the item and dividing by the sales. Okay, now, in a similar manner, in order to get, we're going to use the base formula for all your current items. Current items are generally uh, done as calculated as percentage of sales. If you think about it, accounts receivable, inventory, like that, are directly related to sales. So is accounts payable. So especially if it's for inventory. So short-term investments maybe too. You generate more cash from your sales, and you invest some of it in commercial paper and other things. So for all these current assets here, let's see, all those current assets there, we're going to use the base formula. And what I'm going to do is, what's great about the base formula is all you've got to do is take any line item. It could be any one of those, 4 right there. Any line item which you've calculated with the base formula, and you can just copy it down to another item for which you want to use the base formula, which you're basically calculating that item as percentage of sales. And then for those items, those should be calculated as the percentage, as their percentage of whatever your sales. So if you go over here, and you take cash and divide it by sales, it should come to 3% of sales. I just like to check it. Okay, so it is, cash is 3% of sales. Okay, and I assume the others are too. Okay, now total current assets. This is a subtotal because it is a total something. I'm going to copy these down from here to keep the same formatting. So you've got the subtotal here, okay, which is obviously your total assets, but subtotals must be calculated as subtotals. And do those as a percentage of sales, or your sheet falls apart. You may not know it, but it'll fall apart, and you'll be graded. Okay. Oh, non-current items. Equity method. Everybody in 504, or at least most of you, should know what the equity method is. I would keep those constant because you don't know what you're going to invest in. So long-term investments, I would also keep those constant because you don't know what you're going to invest in either. You don't know what they are, first of all. So if you don't know what something is, and you don't know the companies are buying, et cetera, et cetera, et cetera, I would keep those constant. So, and I generally use that as a rule in my first, let's say, my first version of a set of formulas. I like to keep things that I'm not aware of constant. I have to do more research and then maybe divide it, have a subtable or something like that. It's part you might want to keep part of it constant, part of it percentage of sales, but I doubt it in this case. You would have to have an idea of what their acquisitions were going to be, investments going to be. So I'll just keep those constant. Now here is something that's very important, and I'm going to really emphasize this. A net property, plant, equipment is always done as a percentage of sales. And that may be strange, but think about it. As your sales grow, you've got to have more equipment to produce the goods you're selling. Or even if you're a retailer, if you're selling more, you've got to have more retail space. So there's some relationship. It may not be linear, but there's some relationship between fixed assets and level of sales. That's pretty obvious. The larger, big companies have large sales. They usually have large plant and equipment, unless they're offshoring things. And even then, they might have large lease agreements. But if they're totally offshoring, not so much. But traditionally, large sales means large investment in fixed assets. Okay, so we'll just take the base formula, any one of these. I'll do this one. It doesn't really matter. This is more obvious. Copy down there, and I just want to make sure it worked. And those should be 27%. I should get 27% there. I divide by sales. 27%. Okay, so that's good. Okay, identifiable intangible assets less accumulated amortization. These are kind of important. I'm not going to include these. I'm gonna go ahead and hold these constant. But these are patents probably, because these are drug companies, so these are probably patents. They have a relationship to your sales, but not direct. and I'm going to keep them constant. In a future iteration, I am going to do some research, and what I probably do is do a regression model or something like that to relate their patents to their total sales, and then it's not going to be linear, but there's going to be a relationship there. It won't be. I don't know what type of how reliable or strong the relationship would be. There definitely would be some relationship, but for now, since I'm not aware of that, I'll hold those constant. That's a large number, so that's how large. Uh, Sorry, the goodwill. I'm not sure what companies are acquired, so all of goodwill is a relatively large number. It is a large number compared to the total assets. I'll hold that constant. I still don't know what acquisitions they're going to do. I don't know if they have any impairments, so we'll do that. That's another item for which you do future research. I don't know why I put goodwill in red. It's a number which really you should emphasize if you take a look at it. I'm going to hold uh, these two other items constant because I really don't know what's in there. Deferred taxes. Just look at the deferred tax footnote and see what's going on there. Hold those constant. So my total assets. Here's a subtotal. So I will put a line here because this is a subtotal coming up, and the total is going to be basically the sum of your total current assets, all these assets, all these non-current assets. Notice they don't have a separate total subtotal for non-current assets. So if they did, I would just take the sum of current assets, that line, plus the total non-current assets. But since I don't, I'll take the sum of all these numbers here. I'll take the sum of all those numbers there, and we will come across here, and let's see what they're looking like here. Okay, so my total assets are in the 176 billion range for the last year. I'm looking at this number here. They're going up. Are they going up by? I hold a lot of things constant. That's why they're not going up by 3%. If you hold a lot of things constant, that means that your growth rate there is going to be a little bit lower than that because you're holding some things there, some things are growing. And now we get down to current liabilities. Okay, and notice they don't have a title for current liabilities, and so looking at a real set of financial statements, and you got to deal with the world the way it is. You can't hope that every set of financial statements are like a textbook. So you just got to deal with it. Okay, so that means looking at the statements, understanding what the company did, even if they're not the best formatted statements. Okay, so all current liabilities, generally current items, including current assets, are as a percentage. So I'll use the base formula. You can take any one of those lines and copy them down. We'll come down here to current liabilities, and we'll take those using the base formula, and I'll remind you to use the base formula for those. Using that base formula really saves you a lot of time on these. Okay, and I'm just going to check one just to make sure that it's working. Divide number by sales for last year. If you check the last year, generally speaking, the rest should be working. Okay, that should be 31%. 31%. Notice those two numbers match up, so I'm just running a check on it. And we get a subtotal. Subtotal is current is your total current liabilities right there. And by the way, the total assets is also subtotal. Okay, or total. Take your choice, that doesn't matter. Okay, so I'll put a line here to indicate subtotal. And I will just take the sum of all the current liabilities. Okay, so there's your current liabilities. Should be growing slightly. Yeah, they're growing. Once again, since I held some, it'll be growing at the rate of sales until we get the final balance sheet number here. Okay, now on current liabilities, I would hold all these items here constant because I really don't know what's in these items. You'd have to look at the pension footnote, your taxes payable, what's another. You'd have to do some research here. This is just the first cut. I don't really know what's in there. You have an idea that pensions are pensions, but you have to look at the detail. So we'll leave those constant, and so I'll just go ahead and copy these across. But you'll notice that current items are generally done as a percentage of sales, and non-current items um, initially hold most of them constant, and then you go back. So if you hold them constant, unless it's something very obvious, if you hold non-current items, unless something very obvious, I don't care. Now total liabilities are going to be total current liabilities plus all these non-current liabilities, and then once again, there's no subtotal for non-current liabilities, which gets on my nerves, but okay, that's the way they made these statements. So I'll just accept. You have to work with what you got. Okay, then subtotal. If you start trying to change the format, you can get into problems. Subtotal, that was a subtotal. Okay, then finally, our shareholders' equity. Shareholders' equity um, this is zero. Commitments. Those are lawsuits. Preferred stock, keep stock the same. In all these three accounts, preferred, common, and additional paid in capital, all those three items are when the company issues stock. You don't know if they're going to issue stock or not, so keep those constant. And you can do that for Lilly too. Actually, Lilly's been financing more through debt than stock, so that's not a bad assumption. Keep treasury stock the same too. Those are stock buybacks. Another name for treasury stock is stock repurchase stock that you saw in the statement of cash flow problems. Now here comes the important part of equity, retained earnings. Let's assume no dividends, which is a bad assumption here. In a later model, what you can do is you could actually reduce your cash and reduce retained earnings to simulate um, a payment of dividends. But right now, all we're going to do is take any retained earnings and add net income. We'll assume dividends are zero. And this, all you're doing is an initial cut. The same thing for Lilly. And knowing that if you did it for later versions, you would simulate a dividend by reducing both cash and retained earnings by some dividend. Let's say that you've got a dividend yield of 4%. You just calculate that and reduce cash and dividends and retained earnings by that amount. Okay, and so what we're going to do is take the beginning retained earnings and add to it your net income attributable to the company, the net income that goes into the company. So I want to show you that again. It's your beginning retained earnings plus you go all the way up here, and I'm using net income attributable to Pfizer. And I think that Lilly should have the same, a similar line item, net income attributable to Lilly, which is the net income that belongs to Lilly and that Lilly earned by itself, and that its subsidiaries own, that it's a part of net income that its subsidiaries own that did not belong to non-shareholders that have a non-controlling interest of less than 50% of the other company. So we'll just do that and then just copy that across. Okay, and that in a sense, that is a subtotal. You're adding two numbers there. Okay, and leave, we call this other comprehensive loss in this case. The comprehensive income or loss is an accounting gimmick, so do that same. And then you're going to get the total Pfizer shareholders' equity. You're going to add in the equity attributable to non-controlling interest. That's the part. Think about it. I'm going to repeat this. That's the part of equity that of companies that you control that doesn't belong to you. So if you own 90% of the stock in another company, the 10% is the stock you don't own. That's this 10%. I would go right here. And the reason you're doing that is because when you put financial statements together, when you consolidate your statements with those of all your subsidiaries, put them all together, you take 100% of the assets. So you've got to include 100% of the equity too. Okay, so income attributable to or equity attributable to Pfizer is going to be the sum of preferred stock, and going through here, common stock, additional paid in capital, treasury stock, retained earnings, and AOCI, other OCL in this case, accumulated other comprehensive loss. What happened there? I have to redo that. Okay, they have small shareholders equity, which means they should. That's a small shareholders equity compared to their total equity, which means they have. We saw it in the debt to equity ratio, a relatively high level of debt. All companies seem to. This is a subtotal. That's a subtotal. Okay, then you always note, and if you don't know the relationship between two items, look at the actual statements. You're saying, what did they do with that? Subtract it or add it? They don't have a plus or minus, so a lot of statements don't. You got to look. Obviously, it's going up by 303, so add the 303. Keep that constant because that'll stay constant pretty much unless you acquire another company. Okay, that is constant. The last number here is going to be a subtotal, and in a sense, last column, last number is going to be subtotal to total. Subtotal, same thing. Okay, so your total equity. So this subtotal is going to be. First of all, I'm going to put lines here. I'm going to put lines here because that is a subtotal, and I'm going to put lines here because this is going to be a subtotal, and it's just like over here. 63,143 plus 303 gives you 63,447. I'm going to take 71,789 plus 303. It can be 72,092. Should be increasing. Okay, it is increasing. Okay, and checking a couple things here. Okay, that's constant. Well, okay. Your total liabilities and equity should be sum of total liabilities plus your total equity right there. I put lines there too because that's a subtotal. And just copy across. And we're almost finished. There's one issue which you're going to run into, and this is one of the most important parts of this entire calculation, is that when you finish your initial balance sheet, you're going to notice that your assets, in this case, total assets of 176, do not equal your total liabilities and shareholders' equity. That just happens because we've looked at individual items, but we haven't um, looked at whether or not they're going to sum. And in this case, what you're going to see, what we're assuming here, what we're seeing here is that your total liabilities and equity for all these years, except maybe the first one, but for all these years are greater than your total assets. Notice that the difference expands. Here you have total for the first year for 2020, or for 2020 you have total assets of 169 and total and at about 8,000 you get total liability shareholders equity. Go to the last year, the difference you start with 176 and it's 223, so you got the difference is getting larger. So we're going to have to add something to the upside. We're going to use the cash as a plug. And this is good because this is telling you that your assets need to increase in a sense. And so what we're going to do, and this is standard practice, is I'm going to put the word plug here. There's always a plug in pro forma financial status balance sheet. I'm going to put the word plug there, and I'm going to make it real big and put it in red here, and I'll even put some exclamation points there. I'm going to plug that. That means this is the number which I'm going to use. And I would say do the same thing. Really use cash as a plug. This cash is really the account that changes a lot. My bet, if you're looking at this cash number here, even looking at the short-term investments, which are kind of like cash, it's not going up very fast here. And my bet is that Pfizer is generating a lot of cash. Those 80% margins are generating a lot of cash. Growing very fast, but with high margins, and low growth, you're just going to be a cash cow. If you had high margins and high growth, then that would be the best thing of all. But usually companies with 80% margins are going to be growing, are mature companies that have, especially drug companies that a lot with each sale, but as they lose patents, the growth of their sale goes down. So how am I going to get this to balance? Here's what I'm going to do. I'm going to take cash, say this number here. And I'm going to, this is where I'm going to calculate cash. I'm going to recalculate cash. I'm going to take my total assets and liabilities, total liabilities and equity, total liabilities and equity, and subtract out individually all my non-cash assets. I'm going to do that individually. I like to do it individually rather than subtracting out subtotals. Start with subtotals, and sometimes you make a mistake. It's going to be a long formula, but it's going to be an easy formula. I'm just going to take the other side of the balance sheet. So I'm going to do this. I'm going to take the other side of the balance sheet, that number right there. In order to get it to equal and to use cash as my fill number, for cash, I'm going to take P89, which is my total liabilities and equity, and subtract out every single non-cash asset. So I'm going to subtract all these non-cash assets, leaving out the subtotals, or you're going to run into circular reasoning problems. So I'm going to leave out that subtotal. You can use subtotals sometimes. There's a reason I don't want to get into why it's sometimes best not to. It's just a little more, it takes more seconds, but you should get the number this way. So notice I just took my D89 here, which is my total liability and shareholders equity, and I just subtracted out all my non-cash assets. So let's see what that gives me. My balancing total gives me 177 now. You come down here and 177. So for this year, notice that your balance now equals. Okay, and notice that my cash, and then I'm going to copy that formula all the way across. That finishes my balance sheet. You'll notice how much larger the cash numbers get. And that's more realistic because Pfizer is producing a lot of cash. Now, the next question would be, what's it doing? What would it do with that cash? And in the next iteration, I say, let's pay dividends. Okay, and the way you take dividends, and what I was just mentioning, is that dividends is basically you pay cash out and reduce your retained earnings. So you could build in a separate statement of retained earnings. You can get creative with this thing, or you could just have just reduce your cash and your retained earnings by some number which you compute using the dividend payout ratio, let's say. So, so you say you have so much in earnings, and then you take it out, and you can even build in a target dividend yield or dividend payout ratio. Anyway, so we're done with our balance sheet. This ends the video basically. But after just reviewing that plug, that's such an important concept. I just took D89 or row 89 in this case is my total liabilities and equity, and I subtracted out every non-cash asset. So we come here, you'll notice I took D89, I just subtracted out all non-cash assets. Please leave out the subtotals like current assets, leave that out. And then in all cases, and for all years, it looks like, let's say 223, that resulted in a balance sheet balances. And that's very important. But this is why subtotals have to be subtotals. If I didn't take subtotals, my balance sheet wouldn't balance. If I took them as a percentage, let's say, of assets, if I'd use a base formula for the subtotals also, and if you do this, then it's not going to balance. And even if you do balance in the initial cut, all I've got to do is change the growth rate, and it won't balance. I'll be able to tell that you took a shortcut, in which you'll lose many points on. Okay, so anyway, we have a balance sheet that balances, which is a good point. It's to start the next video. Next two videos, I think, are somewhat shorter, and because obviously income statement, balance sheet. But anyway, I'll put this up.